Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BLOOM Energy CORP quarterly report. BLOOM Energy Corporation offers a range of businesses and services including designing and manufacturing solid oxide fuel cell systems for on-site power generation selling and installing these systems to various industries such as plus utilities, plus data centers, plus agriculture, plus retail, plus hospitals, plus higher education, plus biotech, plus manufacturing, providing the BLOOM Energy Server, a platform that converts fuel into electricity through an electrochemical process, offering the BLOOM electrolyzer for producing hydrogen. BLOOM Energy Corp stock skyrockets. A year of unprecedented growth in a remarkable turn of events, BLOOM Energy Corp stock has surged by an astonishing 1,017% in the past year. This meteoric rise can be attributed to a perfect storm of factors, including robust financial results, AI-driven demand for on-site power, strategic partnerships, and efficient capital allocation. BLOOM Energy's record-breaking revenues, improved gross margins, and significant increase in operating income have set it apart from its peers. The company's fuel cell technology has become the go-to solution for AI-driven data centers seeking reliable and clean electricity. Strategic partnerships with industry giants like Brookfield Asset Management, Oracle, and Equinix have further solidified BLOOM Energy's position in the market. The company's ability to efficiently allocate capital, as evidenced by its outperforming return on invested capital (ROIC), has also contributed to its success. Analysts' positive sentiment, reflected in raised price targets and buy ratings, has only added fuel to the stock's upward trajectory. As BLOOM Energy continues to navigate the high-growth AI and clean energy sectors, it is clear that its strategic positioning and innovative solutions have made it a darling of the market. With a projected 900% growth in earnings per share and plans to double production capacity, investors are eagerly anticipating what the future holds for this rapidly rising star. The primary drivers of revenue growth or decline are multifaceted and influenced by various market and regulatory factors. On the growth side, increasing demand for power due to electrification and sustainability targets, long-term clarity on tax credits, and enhanced competitive position contribute significantly. Additionally, stronger demand for products, improved pricing, and timely project milestones also boost revenue. However, uncertainty in market dynamics, disruptions in global gas markets, and regulatory hurdles hinder revenue growth. Increasing natural gas costs, limited supply, and bans in certain jurisdictions further exacerbate decline drivers. The impact of government policies, such as the South Korean bidding process and hydrogen market developments, also pose challenges to revenue growth. Ultimately, a delicate balance between these factors will determine the trajectory of revenue growth or decline. Net income and profit margins. A shift in favor of the company's net income has shown a significant improvement, with a year-to-date, YTD, 2025 loss of $89.5 million compared to a YTD 2024 loss of $134 million. This change is primarily driven by cost savings and lower rework/production costs. In contrast, the third quarter, Q3, 2025 net income saw a decrease of $8.1 million from Q3 2024. Profit margins have also seen an upward trend. The gross profit margin for Q3 2025 reached 29.2%, a notable increase from 23.8% in Q3 2024 due to cost savings and lower rework/production costs. Similarly, the YTD 2025 gross profit margin stands at 28%, up from 20.6% in YTD 2024. However, equity losses in unconsolidated affiliates have had a negative impact on operating income margins, with Q3 2025 seeing a 1.5% margin compared to -2.9% in Q3 2024. The company is also facing increased maintenance material costs and rising wages and labor costs, which may hinder future growth. Overall, the company's net income and profit margins have shown improvement due to cost savings and lower rework/production costs. However, challenges such as equity losses and increasing costs remain a concern for the company's future performance. The company is generating a significant amount of positive operating cash flow. In fact, it has reported $19.7 million in positive cash flows from operations during the 3 months ended September 30, 2025. This trend continues for the 9-month period, with net cash provided by operating activities also being substantial. The consistent generation of positive operating cash flow is a clear indication that the company's business model is financially sustainable and capable of producing cash to fund its operations. The company's debt level has experienced mixed results over the past year. While some reports indicate a decrease in total liabilities by $111,418, others show an increase of $3.3 million in recourse debt. However, the overall trend suggests that the debt level remains relatively stable. On the other hand, interest expenses have decreased significantly. The company's interest expense has dropped from $-16,763,000 to $-14,390,000, and from $153 million to $101 million over the past year. This indicates a substantial reduction in the company's interest expenses. Management is optimistic about the company's future, with several key initiatives planned over the next few years. In the short term, the company expects to recognize revenue from unsatisfied performance obligations within the next 1-2 years and will issue an annual impact report. In the midterm, management plans to double factory capacity by the end of 2026, driven by growing demand for solutions from AI data centers. The company also expects to capitalize software costs once certain conditions are met. Looking ahead to the long term, management believes that the revised ITC for fuel cell property will enhance their competitive position and create opportunities for growth. They plan to continue making capital investments to expand production capacity and expect interest in clean hydrogen to impact their business positively. Strategic partnerships with Brookfield Asset Management and SK Ecoplant Co., Limited, are also expected to support the company's growth plans. Overall, management is confident that the energy transition towards a net-zero environment will create opportunities for the company, particularly through its fuel-flexible solutions. Acquisitions and divestitures overview. The company has made strategic moves through acquisitions and divestitures to optimize its operations and resources. In terms of acquisitions, the company purchased Safe Harbor Equipment in 2024. This move aimed at enhancing its capabilities and improving efficiency. On the other hand, the company has undergone significant divestitures. Notably, it sold SK Ecoplant shares on multiple occasions. 10 million shares on July 10, 2025, 2.6 million shares on August 14, 2025, and 3.9 million shares on September 29, 2025. These transactions demonstrate the company's efforts to restructure its assets and focus on core business areas. The company's financial summary reveals that one of its notable actions is paying out dividends to shareholders. This indicates a commitment to returning value to investors through regular distributions of profits. Concerns about inventory buildup and supply chain disruption. The financial summary highlights two pressing concerns for the company: inventory buildup and supply chain disruption. The data shows a significant increase in inventories, with a $160 million rise from December 31, 2024 to September 30, 2025, and an overall decrease of $-179,162 compared to the previous year. This suggests that the company may be holding onto excess inventory, which could lead to storage costs and reduced cash flow. Furthermore, there are concerns about supply chain disruption due to various global events. The Russia-Ukraine war, armed conflicts in the Middle East, and geopolitical developments in China pose significant risks to the company's operations. Additionally, disruptions in global gas markets have resulted in system shutdowns, while global supply chain tightness due to inflation, war, and trade tensions has created uncertainty. The escalation of trade tensions between China and the U.S. could also impact the company's ability to source rare earth metals used in electronic components. These risks highlight the need for the company to develop contingency plans to mitigate potential disruptions and ensure business continuity. That concludes the financial summary for Bloom Energy Corp. Feel free to comment below, and I will be happy to answer them when possible.